China cut off US money, and Wall Street lost $1 trillion. That's the headline lighting up your feed. But what actually changed? Tonight we separate heat from facts. Washington tightened the rulebook on where American cash can go in China. Beijing fired back with targeted measures of its own. Meanwhile, the market's biggest wipeout day wasn't a legal ban. It was an AI shock that slammed tech valuations and exposed how fragile sentiment really is. Here's the promise. No hype, just receipts. In the next few minutes we'll track the policy moves, the market mechanics behind that $1 number, who's quietly cutting exposure, and what to watch as rules tighten on both sides. Is this de-risking done smartly, or deglobalization by accident? Let's start with the rulebook that quietly changed the game. Before the panic, there was paperwork. Washington narrowed where US money can flow in China, targeting semiconductors, artificial intelligence, and quantum. The idea isn't a blanket no, it's a gate with two signs. Prohibited, hard stop, and notifiable. You can proceed, but you must tell Treasury. Who's covered? US persons, citizens, residents, companies, and their controlled affiliates, plus anyone facilitating a covered deal. Think fund managers, advisors, or offshore entities acting on US direction. Equity, convertible debt, joint ventures, greenfield projects, and certain tech transfers tied to those sensitive sectors. What's typically out? Truly passive index exposure, broad mutual funds, and routine services, though firms are tightening anyway to avoid facilitation risk. For investors, the effect is immediate. Diligence just doubled. Every China touchpoint gets a tech supply chain scrub, side letters and carve-outs. LPs demand China limitations, GPs spin up ex-China vehicles, timelines stretch, deals that once closed in weeks now wait for council memos and internal committees, cost of capital rises, fewer bidders, pricier risk. Net, Washington didn't slam the door, it narrowed the doorway, especially for frontier tech. That shift alone can freeze marginal deals and make even legal transactions slower, smaller, and more expensive to close. Here's the key: no blanket cutoff from Beijing. Instead, China is using a toolkit of targeted pressure, enough to raise costs and uncertainty for US capital, without shutting the door on money it still wants. First, entity-by-entity penalties. Firms on China's unreliable or sanctions lists face contract bans, licensing hurdles, and steep compliance checks. It's a scalpel, not a sledgehammer. Punish specific players, signal the rest. Second, export and licensing levers. Tighter controls on strategic inputs. Think battery minerals or specialty metals, and approvals that move from automatic to case-by-case, a quiet way to tax time and cash flows. Third, data and security reviews. Cross-border data transfers, cloud, telecom, and critical infrastructure face national security screening. That doesn't kill deals, it slows them, adds lawyers, and sometimes nudges partners to local alternatives. Fourth, procurement preferences. Secure and controllable guidelines push state buyers toward domestic tech, crowding out foreign vendors unless they localize deeply. Fifth, capital windows half open. Stock Connect, QFII, and onshore fund licenses continue, but approvals stretch and discretion rises, especially for US-affiliated managers. The market translation: more ring fencing, China for China strategies, and higher hurdle rates. Beijing didn't flip the off switch, it turned the dimmer down, and made every cross-border dollar work harder. So where did the headline $1 trillion wiped out come from? Not from a single law or a hard ban, but from market mechanics colliding with a fear narrative. One catalyst headline hits: AI competition, policy risk, earnings wobble, and the most crowded trades move first. Mega cap tech and China exposed names. When those leaders fall, index math magnifies the damage. A few giants carry outsized weight, so a sharp slide there erases hundreds of billions in market cap across the benchmark in minutes. Then the machinery kicks in. Volatility targeting and risk parity funds cut exposure. CTA trend models flip. Options dealers hedge as gamma turns negative. ETFs see redemptions and must sell the underlying. Add margin calls and systematic stop losses, and the sell-off feeds on itself. None of that requires a new decree from Beijing, just positioning, liquidity, and sentiment moving together. Fundamentally, the valuation reset is simple. Investors reprice growth, margins, and policy friction. If AI leadership looks less certain or cross-border compliance costs rise, multiples compress. That's how you get to $1 trillion day on paper. Not one switch flipped to off, but a chain reaction through indices, derivatives, and passive flows. Translation: the wipeout was a market event, not proof of an absolute investment cutoff. Look past the headlines and watch the positioning. Big brand name funds aren't exiting China wholesale, but many are trimming, ring fencing, or moving to China for China mandates. Public markets teams cut single name risk and lean on broad indices or swap exposure to stay liquid. Private equity raises ex-China side vehicles and inserts deal-by-deal vetoes for sensitive tech. Venture rotates toward applied AI and industrial software that avoids restricted chips. Multinationals do the same. Chip and tool suppliers split product lines, keeping advanced nodes out while servicing legacy demand. Auto and battery players localize deeper, more onshore partners, fewer cross-border dependencies. Cloud and data-heavy firms add local JV shells and sovereign cloud options to pass security reviews. Asset managers negotiate side letters with US LPs. No semi/AI quantum, tighter reporting, kill switches on sanctions. Net effect, exposure doesn't vanish, it changes shape. Shorter duration, smaller bites, more compliance friction. The signal is consistent across filings and guidance calls. Keep optionality, reduce headline risk, and wait for the rulebook to settle. Policy friction doesn't just make headlines, it reprices risk. First, capital gets pricier. Lenders widen spreads, equity investors demand a higher return, and sensitive deals slip below the hurdle rate. Second, timelines stretch. Extra counsel, audits, and security reviews push closings from weeks to quarters. The longer the gap, the higher the break risk, and the lower the bid. In public markets, you see multiple compression on China-exposed revenue, FX hedging costs creeping up, and basis gaps between ADRs and onshore shares during stress. ETFs amplify moves. Redemptions force mechanical selling of the underlying, while volatility products magnify swings. On the credit side, spreads widen for issuers tied to restricted tech or complex supply chains. Some borrowers pivot to shorter tenors. For asset managers, tracking error rises as they carve out sectors, and compliance overhead becomes a real line item. KYC, data residency, third-party risk. Net effect, not a crash every day, but a higher friction market where money moves slower and demands more. Winners, onshore China managers with local LPs, China for China suppliers, nearshoring hubs, Mexico, Vietnam, Malaysia, India, that catch diverted capex, legacy node chip and tools vendors, mature processes stay legal, custom/logistics firms smoothing reroutes, and the cottage industry of compliance, legal and data residency services, under pressure, US VCPE targeting restricted semis, AI quantum, cross-border banks and brokers stuck between regimes, ADR-heavy issuers with headline risk, multinationals whose SKUs rely on advanced nodes or sensitive software, exporters with dollar liabilities but RMB revenues, retail gets whipsawed, CFOs pay more for hedges, governments gain tariff chatter, but risk slower growth if investment detours last. The biggest risk is policy whiplash, overnight rule changes on either side that strand capital mid-deal. Next, extraterritorial enforcement, secondary sanctions, facilitation claims, pulling global banks into the crossfire. Data localization and security reviews can stall cloud, fintech and health projects. Export control creep may widen from chips to tools and software. Watch FX and rates shocks, especially if dollar funding tightens while revenues are RMB. Election cycles raise headline risk. A single hearing can move spreads. Add audit/IPO scrutiny, cyber allegations, and countermeasures like entity lists or license revocations. Finally, credit stress, property or local government debt can turn friction into funding freezes fast. Watch 5 dials, Treasury rulemaking, definitions for AI, semis, quantum, grandfathering, facilitation guidance, Beijing countermoves, new unreliable entity additions, license delays, data localization rules, free view machinery, CFI-US outbound coordination speed and scope, more voluntary filings, market tells, ADR onshore basis, FX basis, credit spreads for China-exposed issuers, ETF outflows. 5. Capital behavior, LP side letters, ex-China vehicles, Bridgewater-like trims, bank KYC memos, also track listing/audits, PCAOB, HK pivots, currency usage and trade invoices, and earnings guidance that quantifies China sensitivity. If 2 or more dials flash red together, expect volatility to compound. This isn't a curtain drop, it's a narrower bridge. Washington tightened outbound rules. Beijing answered with targeted friction. Money still moves, but slower, costlier, and with stricter guardrails. The $20 wiped out moment was a market mechanics shock, not a blanket ban. Winners localize, diversify, and separate China for China from global P&L. Losers cling to old playbooks and ignore compliance risk. Your checklist, shorten duration, hedge FX, ring-fence data, avoid restricted tech, and price policy risk like it's real, because it is.